Welcome to Brain on Books YouTube channel. Today we're diving deep, really deep, into the wild world of early stock speculation. Think turn of the 20th century. Our guide is the hard-won experience of one of history's most legendary stock operators. We're not just talking dollars and cents here. This is about the psychological battlefield, the absolutely grueling and incredibly expensive process of figuring out the rules in a game that was, frankly, often rigged. For you listening, imagine getting lessons that cost someone else millions, bankruptcy, multiple times over, just to learn what not to do.
Exactly. That's the core mission today. We're trying to distill decades of this incredibly intense education. We'll start in those notorious bucket shops, where the house always had an edge, and move all the way up to the big leagues. Wall Street, the New York Stock Exchange, with its own sophisticated manipulations. We want to pull out the strategies that worked eventually, but maybe even more importantly, highlight the critical mistakes, the psychological traps that lead to losses. Think of this as getting a catalog of the biggest don'ts in speculation, lessons learned the hard way by our source, delivered right to you.
Okay, let's start at the bottom rung then. The bucket shops. What exactly were these places? Because they weren't like brokerages today, right?
Not at all. They were essentially betting parlors.
Yeah.
You weren't actually buying or selling stock on an exchange. You were just placing a bet with the shop owner on whether a stock's price would go up or down. They range from, tiny backroom operations.
The humbler ones, as our source called them.
Right, the humbler ones, up to really lavish places like the Cosmopolitan. That one was supposedly the biggest, wealthiest bucket shop in New England. Big operation.
And right off the bat, the game was tilted against the customer.
Oh, absolutely. Even before you get into the outright scams, the basic mechanics were designed to drain your capital. Take margin requirements. Some tiny shops might let you trade on a tiny margin, maybe 5 shares worth. But a place like the Cosmopolitan, they demanded a 3-point margin up front.
Okay, 3 points. What does that practically mean for someone walking in with, say, $3,000?
Well, normally, with a 1-point margin, that $3,000 might let you control, theoretically, 3,000 shares or points of movement. But with a 3-point margin, your trading capacity is immediately slashed by 2/3. That same $3,000 only lets you control 1,000 shares.
Wow, so your potential is cut dramatically right from the start. Less firepower.
Precisely. Less firepower. And then there's the pricing itself, pure friction built in. Our source gives this great example. He wants to buy steel. The actual ticker tape from New York says the price is 90.
Okay, 90.
But the ticket he gets from the Cosmopolitan, it instantly reads, bought steel at 91 1/8.
A point and an eighth higher? Just like that.
Just like that. So the stock has to move up a full 1.25 after he buys, just for him to break even if he sold immediately.
That's built-in slippage. It's designed to just bleed you slowly on every trade.
Exactly. It punished quick scalping and made sure any tiny bit of market noise could wipe out your margin. But here's the strange part, the paradox.
Okay.
Because the shop wasn't executing real trades, they didn't want the hassle of chasing customers for debts if they lost more than their stake.
Yeah.
So they had this automatic stop loss. If the market moved against you and the price drop exceeded your margin, poof, your trade was just closed out. Done.
Wait, hang on. So the fact that it was a scam actually gave traders better risk management than a real broker might have back then?
Kinda. That's the irony. The operator himself points this out. He said, you couldn't get stung for more than you would put up. That automatic cutoff probably saved a lot of small players from devastating debt they might have faced in a real brokerage, especially during a panic.
But let's not mistake that for fairness. They were just protecting themselves, right?
Oh, absolutely. Minimizing their own risk and collection headaches. Fairness wasn't part of the equation. And they were masters of outright scams, especially when the shop itself was on the hook for too much money if customers won.
Like the thimble rig example. Tell us about that.
Right. So our operator and a partner, Henry Williams, they were short a lot of sugar stock, maybe 6,000 shares between them. They bet the price would go down. The Cosmopolitan shop realized they were holding maybe 8,000, 10,000 shares total short on sugar from various customers. That's a big potential payout for the shop if sugar tanks.
So the shop has a strong incentive to make sure sugar doesn't go down.
Exactly. Or better yet, make it go up just enough to wipe out those shorts. So what did they do? They used their own brokers on the actual New York Stock Exchange floor to manipulate the price. They drove sugar straight up, artificially, to 108.
Just high enough to trigger all those stop losses based on the margins?
Precisely. Every short position gets liquidated. The shop collects all that margin money.
And then what happened to the sugar price?
The moment the shorts were wiped out, it fell right back to where it was before. The move had zero basis in reality. Pure manipulation.
Incredible. And people knew this was happening.
Oh, yeah. Newspapers back then even had a term for it. When they saw these sudden, unexplained spikes or drops followed by an immediate recovery, they called it a bucket shop drive.
So everyone knew the small guy was often trading against a deliberately hostile house.
Absolutely. And the shops had other ways to protect themselves, too. They'd restrict trading. Think about the 1900 McKinley election. Everyone knew McKinley would likely win, and historically, that meant a market rally the next Monday. Easy money, maybe 3 to 6 points.
So a smart play would be to go long just before the weekend.
You'd think so. But our operator said no bucket shop in the country would take buy orders that Friday before the election. They just refused. Too much certainty for the customer.
Wow. They wouldn't even take the bet if the odds looked too good for the player.
Nope. And they limited profits on volatile stocks, too. The football order stocks like sugar, Tennessee coal, and iron. You might see a stock clearly ready to jump 10 points, but the shop might cap your profit on that ticket at just 2 points. They couldn't stand seeing a customer make too much too fast.
So despite all this rigged environment, our operator learned something valuable. He survived it, right?
He learned resilience, tactics, how to read the immediate situation, and that became crucial later. After he lost his first big stake in New York, we'll get to why that happened, he needed cash. He needed to rebuild.
What did he do? Borrowed $500, right?
Yeah, borrowed $500. And where did he go? Not back to a Wall Street firm. He went straight back to a bucket shop environment. Why? Because, as he said, I know that game.
He knew how to beat that specific rig system.
Exactly. He couldn't trade in New York anymore, too regulated, and his hometown shops knew him too well. So he went to St. Louis. And there's this great little story about his strategy at a place called the Hoboken Teller Shop. It shows his calculated approach. He figured the big traders on the main exchanges often tried to raid stop-loss orders late on a Saturday, causing a brief dip just before the noon close.
So he anticipated that dip.
Precisely. He went in that Saturday, put up $2,000 cash, and shorted several stocks right before he expected the dip.
And did it happen?
Like clockwork. The stocks got hammered briefly, prices slid, he covered his shorts just before the usual end-of-day rally.
Quick in, quick out.
Quick in, quick out. And then, critically, he immediately demanded his winnings in cash. $5,100. He forced the manager to pay him right then, knowing they'd pay the little fellows first to keep business flowing. He knew the shop wouldn't risk stiffing him if things were busy.
That's not just trading. That's understanding the whole environment, the psychology of the shop manager even. A real hustle.
It was pure hustle. Mastering that specific localized game was key to his survival and eventual return to bigger stakes.
Okay,
So he rebuilds his capital. Now, the transition to Wall Street. A legitimate brokerage, A.R. Fullerton & Co. And this is where the really expensive lessons begin. Because the very system that made him successful in bucket shops, it completely failed him here.
Why? What was different? He was still reading the tape.
He was reading the tape, yes. But his bucket shop success was built on lightning-fast scalping, taking tiny profits, like half a point, on hundreds of shares, based purely on the price printed on the tape. In the bucket shop, the tape price was the settlement price, even if it was delayed. But at Fullerton's, he was actually buying and selling real stock on the exchange floor.
So there's a delay. The tape isn't the real-time price on the floor.
It's exactly a potentially huge delay. He talks about seeing a stock clearly dropping 3 points on the floor. But the ticker tape scrolling past him might still be printing the price from minutes ago, say 105, when the real price is already 102.
So if he tries to sell based on the tape showing weakness at 105?
By the time his sell order hits the floor, the price could be much lower. He's selling into the hole, not at the price he saw. His whole scalping system, relying on that instantaneous tape price, just fell apart.
That must have been a brutal realization. The skills were useless, even counterproductive.
Completely. And it led him to this profound question. If with all I had, meaning his experience, his capital, his tape reading skill, I still lost, what chance does the green outsider have of cashing in?
He realized he only knew part of the game.
Right. He knew the tape, the surface, but he didn't understand the deep mechanics, liquidity, execution delays, institutional plays, the whole game.
And the risks on Wall Street weren't just about system failures. Execution itself could be deadly, right? The Northern Pacific corner in 1901 is a prime example.
Oh, absolutely legendary. This wasn't just market noise. This is a battle royale between financial titans, Harriman and Morgan, fighting for control of the Northern Pacific Railroad. Our source called it an irresistible force meeting an immovable object. Both sides were desperately buying stock, driving the price to insane levels.
And our operator was caught in this.
He was short some stocks when the real panic hit on May 9th. The market went absolutely wild. He tried to sell, placing orders at the market.
Which normally means sell at the best available price right now.
Right. But the volume was so immense that ticker tape fell hopelessly behind, minutes behind. So an order he placed when the tape showed the price was, say, 100.5 might actually get executed on the floor at 80.
A 20-point loss just on the execution lag. Ouch.
Exactly. He realized instantly he wasn't selling high. He was selling at bargain basement prices he should have been buying. The execution risk was devastating.
What did he do? Panic.
No, his mind worked incredibly fast. Seeing the collapse in the tape lag, he made an instant decision. Cover the shorts immediately and go long. He figured if it was collapsing that fast, the rebound would be just as violent.
Gutsy move. Did it work?
Well, he got his orders in, but even covering those shorts happened at panic prices. Some filled way up at 172, 174. It just shows the incredible friction and chaos.
The lesson being, even with a good broker, in a real panic, the market mechanics themselves can destroy you. Liquidity vanishes.
Precisely. Capital and conviction mean nothing if you literally can't get your orders executed reasonably. And this execution risk wasn't just during mega panics. There was also the everyday problem of unreliable brokers, and especially the tipster epidemic.
Ah, yes, the promise of inside information.
Even with decent firms, delays could cost you. But the real danger lay with the wirehouses. These weren't your small-time bucket shops. They looked legitimate, nice offices, wire connections often catering to wealthier clients.
But they were still essentially bucket shops.
Sophisticated ones. They'd promise inside tips, charge a slightly higher commission, maybe an extra 30-second. But often, they never actually sent your order to the exchange. They just bet against you, booked the trade themselves.
So they profited directly when you lost.
Exactly. Our operator investigated one manager who was brutally honest about it. He basically said, look, these customers are bound to lose their money anyhow. It doesn't matter how. So he figured, I might as well get as much of their money as I can and then look for a new crop of losers.
That's chillingly cynical.
It solidified the operator's view. You absolutely cannot rely on tips or trust firms whose business model benefits from your failure. They have zero incentive to help you win.
So, after understanding the flaws in his old system and the dangers of Wall Street mechanics and bad actors, what was the big shift?
Discipline. Internal discipline. He realized the biggest enemy wasn't the market or the manipulators. It was himself. The single greatest lesson. Resisting the urge to trade constantly. He said the downfall of most people in Wall Street is thinking they must trade all the time.
The need for action. The fear of missing out.
Exactly. He learned the power of patience, of sitting still. If I cannot advance, I do not move at all. The market doesn't reward activity. It rewards being right and patient.
He distinguished between the plain fool and the Wall Street fool.
Right. The Wall Street fool is the one who thinks he has to be in the market every single day, making bets. This cuts right to the core psychological battle-fighting greed, hope, fear, impatience. He realized, after going broke multiple times, what beat me was not having brains enough to stick to my own game. He was his own worst enemy when he deviated.
And this ties into actually making big money, right? It wasn't just about being right about a move.
That's a crucial distinction he made. He stressed, it never was my thinking that made the big money for me. It always was my sitting tight.
Sitting tight, holding on through the noise.
Yes. It's one thing to buy a stock at 100 and sell at 105 for a nice profit. Anyone can do that. But the big money comes from buying at 100 and having the discipline, the patience, the sheer nerve to hold it while it goes to 110, maybe dips back to 105, tests your resolve, and then continues on to 140 or 150.
That requires overcoming the constant urge to lock in small gains.
Immensely difficult. He figured it takes about 5 years just to learn the basics of intelligent trading.
Yeah.
But making big money, that only comes after you master sitting tight, riding the major trend.
And all that effort trying to scalp tiny moves.
He called trying to catch the last eighth or the first eighth of a move, the most expensive eighths in the world. It just grinds down your capital and your mental energy, makes you miss the real significant moves.
Okay, so patience is key. How did discipline affect how he actually put money into a trade? You mentioned pyramiding.
Right, pyramiding. And his method was totally counterintuitive compared to how many people still approach it today. The semi-sucker way, as he called it.
So how did he do it? Buying on strength.
Exactly. If you're buying because you expect a rise, you buy when the stock is already moving up. You need confirmation from the market. Say you buy an initial lot, 2,000 shares at a 110. If it quickly goes up to 111, that's the market validating your judgment. That profit is your signal it's okay to buy more, maybe at 112 or 114.
You're adding to a winning position using the market's confirmation.
Precisely. You're scaling in because you're right so far. And crucially, if that first purchase at 110 immediately shows a loss. If it drops to 109,
What then?
out I go, he said. Cut the loss immediately. It doesn't pay to start wrong. You want the market moving with you from the first trade.
Okay, so that's buying on strength. How does the semi-sucker do it?
The semi-sucker loves to buy onto declines. They see a stock that was 100, now it's 98. Bargain, they think. So they buy.
Then it drops to 95.
Even better bargain. So they buy more. They're averaging down, buying based on how far it's fallen from a peak, hoping they're catching the bottom.
But they're fighting the trend.
They're fighting the immediate trend, the line of least resistance. If the stock is going down, buying more just means digging a deeper hole. It's based on hope, not confirmation. That's how people get wiped out.
Buying on declines is dangerous. Okay. And what about ignoring your own system because someone else, even someone smart, gives you a tip? The $40,000 lesson.
Oh, that's a painful one. A classic example of letting outside influence override hard-won conviction. He was long Union Pacific. The tape looked strong, indicating accumulation around 160. His system was screaming, buy or hold.
Everything looked good based on his own analysis.
Yep. But then a friend, Ed Harding, smart guy, well-connected, someone he respected, pulls him aside. Harding insists, based on supposed inside info, that the stock isn't being bought up, it's being secretly fed out by insiders. He tells the operator he's being played for a sucker.
So fear and doubt creep in despite what the tape says.
Exactly. He lets Harding's story get in his head. He abandons his own analysis, sells his long position, and then doubles down on the mistake by going short 4,000 shares around 162.
Oh no, what happened?
The very next day, the Union Pacific board announced an unexpected dividend increase. The stock exploded upwards massively.
And he's short 4,000 shares.
He had to cover, scrambling to buy back shares as the price rocketed. Some buys were filled as high as 174. The mistake cost him $40,000. A huge sum back then. The tape was right. His system was right. The insider tip from his smart friend was dead wrong. He paid $40,000, as he put it, for not having the courage of his own convictions.
Yeah.
His conclusion, no tip, no guru, no smart friend can consistently make you more money than sticking to your own disciplined, fact-based analysis. Trust the process.
Okay, that brings us to a core concept for him. The line of least resistance, what exactly is that?
It's maybe the central pillar of his mature trading strategy. It's not about predicting the far future. It's about figuring out the path the market is most likely to take right now in the immediate future based on the existing pressures and conditions.
So identifying the dominant force at that moment.
Exactly. And crucially, you don't force it or guess it. You wait for the market itself to define that line. He used the example of wheat trading in a range, say between $1.10 and $1.20. It just bounces back and forth.
The amateur tries to guess the turning points inside the range.
Right. Will it bounce off $1.10 this time? Will it break $1.20? The professional, following the line of least resistance, waits. They wait until the price definitively breaks out of the range. If it pushes decisively through $1.20, that's the signal.
Because the upward momentum has proven stronger than the resistance at $1.20.
Correct. Buying at $1.20 at a fraction, even though it feels expensive compared to buying lower in the range, is actually safer because the path of least resistance is now clearly upward. You're trading with the confirmed momentum.
Trading certainty, or at least high probability, over hope.
That's the essence of it. And interestingly, he found that when he was positioned correctly along the line of least resistance, unexpected events or accidents usually helped his position. If the underlying trend is up and you're long, a sudden piece of good news just accelerates your profit. If the trend is down and you're short, bad news helps you. But if you're fighting the trend, those same random events are more likely to crush you. Being aligned with the path of least resistance puts probability on your side, even for the unforeseen.
That makes sense. Now, you mentioned using information strategically. The Jesse L. comic story sounds fascinating, using a pip in a completely counterintuitive way.
Oh, it's brilliant. Comic was known as a major bear operator, generally pessimistic about the market. He gets this rock-solid tip from a reliable insider. The powerful William Rockefeller is secretly, systematically selling shares of St. Paul Railroad stock. 1,500 shares every time the price ticks up 38ths of a point. Continuous selling pressure from a major player.
Okay, so the obvious place seems to be short St. Paul, insider selling, price going down, right?
That's what 99% of traders would do. But Kamek, he does the exact opposite. He tells his broker, every time St. Paul ticks up 38ths by 1,500 shares, he becomes the buyer, absorbing Rockefeller's selling.
He's buying into the selling. Why?
He ended up buying 60,000 shares this way. He wasn't bullish on St. Paul itself. He was accumulating ammunition. He knew Rockefeller's selling couldn't last forever. He was patiently absorbing that supply. When the insider selling finally dried up,
What did Kamek do with his 60,000 shares?
he dumped the entire position onto the market at once, and then immediately went short even more St. Paul on top of that. The sudden lack of Rockefeller's selling support, combined with Kamek's massive dump, created intense downward pressure. He used that manufactured drop in St. Paul to trigger and lead his real objective, a major profitable bear campaign across the entire stock market list.
Wow. He used a specific stock and a specific insider action not for the stock itself, but as a tactical weapon to initiate a much larger market move. That's next level thinking.
It's pure strategic opportunism,
Yeah.
using the conditions, not just reacting to the news, playing the player, not just the stock. And this leads into how our operator viewed manipulation in general. He insisted it wasn't some dark magic. Primarily, he saw it as a merchandising process.
Merchandising, like selling goods.
Essentially, yes.
Yeah.
Especially for large pools or insiders who needed to unload huge blocks of stock. The goal wasn't just to pump the price, but to create marketability, to make it possible to sell enormous amounts of stock to the public at the best possible price without crashing the market in the process.
So what's the core rule of this art of manipulation?
Simple and brutal. Stocks are manipulated to the highest possible price, then sold to the public on the way down.
They get the public to buy after the smart money is done buying and ready to sell.
Exactly. And the key tool for convincing the public, the ticker tape. He called the tape the most persuasive of all salesmen. The manipulator uses buying and activity to make the tape tell a story of strength, demand, rising prices that convinces the public it's a good time to buy, even when the insiders are secretly selling.
But if they're selling huge amounts, won't that drive the price down too fast and scare people off?
That's where the stabilizing process comes in. It's sophisticated. As they sell and the price naturally starts to drift down, the manipulator must be ready to step in and buy back some shares, cover their shorts temporarily.
To support the price, make the decline look orderly.
Precisely. They buy just enough on the dips to stop a panic, to make it look like a healthy pullback or consolidation. The public sees the dip, sees it recover slightly, and thinks, okay, good time to buy more.
Meanwhile, the manipulator is still quietly feeding out their main block of shares whenever the price rallies a bit.
Exactly. They support the decline just enough to keep the public buying, ensuring an orderly distribution until their entire position is unloaded onto the unsuspecting crowd. It's merchandising on a massive scale.
Okay, so we've covered market mechanics, psychology, strategy, but some lessons seem deeply personal. The Dan Williamson story sounds particularly painful. The cost of loyalty.
Yeah, this one cost him more than just money. It cost him years. Williamson was a respected figure, senior partner in a big firm, connected. He approaches our operator, offers him $25,000 backing, promises essentially unlimited funds, asks him to trade exclusively through his firm, and he specifically wants to leverage the operator's reputation as a known big trader, an active bear.
Sounds like a great opportunity. Why was it a trap?
Because Williamson had a hidden agenda. His wealthy brother-in-law, Alvin Marquand, was terminally ill. Marquand had enormous speculative stock holdings that needed to be liquidated quietly before his death became public and crashed the prices.
So Williamson needed cover. He needed market noise.
He needed a smokescreen. Our operator's high-profile aggressive trading provided the perfect distraction. While everyone was watching the famous plunger, Williamson's firm could quietly sell off Marquand's billions.
And the operator felt grateful, loyal.
Deeply grateful, which completely paralyzed his own trading judgment. He knew the market was weak, the line of least resistance was down. His system told him to be aggressively short, but he felt he couldn't. Selling aggressively would hurt Williamson's secret liquidation plan. Loyalty and gratitude completely overrode his objective market analysis.
What was the result for his own account?
Financial disaster. He lost all his trading profits and ended up owing Williamson's firm $150,000. Now, Williamson mysteriously cleared that debt, probably to keep the whole scheme quiet, but the real cost was far greater.
The lost time.
5 years. He said the experience effectively took him out of the game during the greatest opportunity of a lifetime for trading. 5 years of prime market conditions lost because personal feelings trumped market facts. The market, he learned, doesn't care about loyalty.
A brutal lesson. And then there's the unexpected things you just can't plan for, like the coffee trade.
Right. If loyalty blindsided him, this was a bolt from the blue. And ironically, his coffee trade during World War I was probably the most logical, almost investment-like play he ever made.
What was the logic?
Simple supply and demand. Wartime meant dwindling coffee imports into the U.S., but consumption was relatively fixed. People still drank coffee. Meanwhile, almost every other major commodity, wheat, cotton, sugar, had already soared 250–400% due to wartime inflation. But coffee, still languishing at pre-war prices.
So it seemed like an inevitable catch-up was coming, a guaranteed profit.
It looked absolutely certain. He bought huge amounts of coffee futures, held them for a year, took a small loss at one point, then tripled down, buying even more. He was convinced millions in profit were locked in.
He was right about the market logic, wasn't he?
Completely right. The price was set to explode upwards, but then came the unexpected.
Government intervention.
Exactly. The coffee roasters, the big industrial buyers who were short coffee and stood to lose millions if the price rose, appealed to the government's War Industries Board. They framed it as patriotism, claiming our operator was a speculator trying to corner the market and profiteer during wartime.
And the government bought it.
They did. The board stepped in, fixed a maximum price for raw coffee well below where the market was heading, and crucially, ordered all existing futures contracts to be settled at that artificially low price.
Wiping out his entire position.
Instantly vaporized his multi-million-dollar paper profit. Despite his logic being perfectly sound, a completely unforeseen political decision overruled the market.
That's terrifying for a trader. You can do everything right and still get crushed by something totally outside the market.
It adds another layer of risk. The unexpected. Political risk, regulatory risk, things beyond calculation. And the irony. He notes the price controls later caused shortages and made coffee even more expensive for consumers anyway.
A final psychological trap, he mentioned the Wall Street hoodoo, trying to make the market pay for specific things.
Yes, this is a huge one. Maybe the most common way traders sabotage themselves is when you start trading not based on market conditions, but because you need money for something specific right now.
Like, I need to make $5,000 by Friday to pay for a new motorboat, or I need $1,000 for an unexpected bill.
Exactly. That external pressure, that specific need, turns speculation into pure gambling. You can't wait for the right setup, for the line of least resistance to define itself. You force trades, you take bigger risks, you bend your own rules because you're hoping the market will just be nice to you at once and give you the money you need.
And the market rarely cooperates with personal deadlines.
Almost never. Trying to make the market buy you an overcoat or pay your rent is one of the surest paths to ruin. It forces impatience and emotional decision-making.
So looking back at this whole journey, the bucket shops, Wall Street, the wins, the bankruptcies, what's the unifying thread? It really seems to be this constant internal battle, doesn't it? Fighting your own impulses, greed, fear, hope, impatience.
Absolutely. That's the core struggle. Success came down to rigorous discipline, sticking to a fact-based system and respecting that line of least resistance.
He got wiped out multiple times, but he saw those losses as tuition. He kept learning about the market and, crucially, about himself. That resilience is key.
And perhaps the final, ultimate lesson he distilled from it all, the one truth that stands above everything else.
What's that?
He said, a man may beat a stock or a group at a certain time, but no man living can beat the stock market. The game itself is bigger than any player. It demands discipline. It demands trading the conditions, not the hopes. And, the fundamental mistakes people make. The psychological traps, they remain exactly the same, decade after decade. The players change, the game's core challenges don't.
If you want to listen to a detailed summary of more finance-related books, then hit that subscribe button now.